Good evening to everyone, and thanks for joining us tonight. As we were talking about briefly, I know there's a lot of other things you could be doing on a Wednesday evening in Albany, New York, instead of being here with us tonight. But again, really appreciate your attendance. So on behalf of staff members Lisa LaPlante and Michael Whitney, again, I want to welcome you to our dual presentations this evening. And I much rather would have preferred, obviously, to have all of this in person as we had originally tried to do. But again, for various reasons, some obvious, some not so obvious, we weren't able to do that tonight. So again, I'm looking forward, just as I know everybody else is out there, to a much better 2022. And again, once we can all get together again, the way things used to be, not that long ago. But we're going to do the next best thing this evening, okay? And I'm really excited about the program tonight. Dave Kibe is with us from the Capital Group. He'll be on shortly. He's here to talk about what he thinks his long-term perspective is on the markets, on the economies. And then I'm going to change gears a little bit, and I'm going to talk about some more important aspects of cybersecurity and how you can protect yourself immediately. So we're looking forward to that as well. But quickly, just a few announcements up front. So first of all, I would ask that you would save your questions till the very end of both presentations, just to make sure that we get through all the valuable content here tonight. Okay, so save your questions till the very end. And at that time, after both presentations, if you do have questions, you can click on the bottom. So on the bottom of the screen here, you'll see a little button that says reactions. And there's a little smiley face on that button, reactions. So you hit that button and then you'll see a raise your hand sign. So you can click that. And then Lisa will see you and allow you to come on live and ask your question, just as we would normally do. If that doesn't seem to be working for you, you can always shoot Lisa an email as well. You can type out your question, and she'll make sure that we read that on the air tonight. LaPlante, right, at Albany Financial Group, Lisa? Okay, I should know that by heart.
That's correct.
That's what it is. Okay, good. And for those of you in attendance tonight, whose emails that we currently have, you should have received a PDF version of our Savvy Cybersecurity Quick Reference Guide. Okay, so that's, if you haven't seen that, hopefully your spam filter didn't pick that up and it's in your inbox somewhere. We're going to talk about that a little bit later on this evening, but you should have that. And for those of you attending that we don't have your email, we'd be happy to get a copy of that PDF to you. Just get in touch with us and we'll get that out as soon as we can. And lastly, I wanted to mention that if you're not aware, we've started a new podcast here at Albany Financial Group, and it's entitled Invest in Knowledge. So it's a podcast, a monthly podcast that I'm doing, just started in October, and it's a podcast about all things financial. So you can find that podcast at our website at www.jgigliello.com or wherever you get your podcasts. And the first episode actually is a much more detailed version of what I'm going to talk about tonight on the cybersecurity front. So check that out. If you're not familiar with podcasts, and many people are not, it's a really fun and easy way to educate yourself on just about any topic that you want. So again, if you need more help with that, contact our office and we'll get you started with that. Okay, so that's what I have for this evening as far as administrative notes. What do you say we dive right into tonight's presentation? So let me go ahead and introduce David Kibe. And David is a well-respected and trusted partner of ours here at Albany Financial Group. Dave works with the Capital Group. He's a wholesaler for the Capital Group, home of American Funds. and he covers the Eastern and Central Upstate New York region. Capital Group and American Funds has more than $2.2 trillion of assets under management, and many of you own their funds. Dave has 13 plus years of industry investment experience and has been with Capital Group for 7 years. Prior to that, he was with JP Morgan Asset Management, and he holds a bachelor's degree in political science and economics from the University of Scranton. He also holds the Chartered Retirement Planning Counselor, Certified Investment Management Analyst, and Accredited Investment Fiduciary designations. Dave is based in Wilton, New York. So Dave, thanks so much for being here this evening, and I'll let you take it away.
John, thanks so much for that very friendly introduction. It is an absolute pleasure to be joining everyone on the call this evening. As John mentioned, my name's Dave Cobb with the American Funds. All that other fun stuff, we'll have a quiz at the end to see if you can remember any of it.
Good, fair enough.
But all jokes aside, it truly is a pleasure to be here. And as John said, an absolute partnership between myself, John, and frankly all of Albany Financial Group over the last number of years, and it's been awesome. So happy to always be part of anything that the group puts on. So my pleasure to absolutely be here. So just very quickly, John did a great job from an introduction perspective, giving a little background on myself, around the industry, how we work together. But probably the most important thing about my job, as I always like to tell people, is I'm essentially the liaison between the really, really smart people at our firm, those portfolio managers and analysts that are making investment decisions with your hard-earned money that you've entrusted with us, and financial advisors like John and the rest of the folks at Albany Financial Group. So I just want to make sure that people understand the connection there. I essentially am responsible for providing John and his colleagues updates around what we're thinking, what we're doing inside the portfolios, where are there areas of opportunities that we're seeing, where are the risks that we're seeing in the world today. Hence why John, I think, asked me to come on tonight and talk a little bit about what we are seeing out in the world today. Before I do that, very quickly, I wanted to let you know, John mentioned I cover Eastern and Central Upstate New York, which is accurate. What he didn't say in there is I actually work with about 5,000 financial advisors. And I think I can count on my fingers and toes how many people actually take the time to put events like this together for their clients. So you are in very good hands with John. And I know Lisa as well put a lot of effort into making this program what it is tonight. So thank you, Lisa. Thank you, John, for what you do on behalf of your clients. So let's talk about what we're thinking and what we're talking about here at Capital Group and American Funds. And I think first and foremost, it's got to be okay, Dave. We've had quite an interesting run in the stock market here over the last, call it just shy of 2 years. What can we expect going forward? Well, I'm going to answer this in 3 different ways. I'm going to answer it over the next, call it 12 to 18 months, which we would label the near term. I'm going to answer it over the long term, which we think 7+ years out, right? And then kind of that intermediate term. So call it that 2 to 6 year intermediate term. That's the way we're kind of thinking about things here at American Funds and Capital Group when we're looking for investments and how to position portfolios. So from a near-term perspective, which everybody seems to concentrate most on, which I'll warn you, you probably shouldn't, but from a near-term perspective, quite frankly, we think things are pretty good. It's not unicorns and puppies and rainbows by any stretch of the imagination, don't get me wrong, but things are in pretty good shape, right? We've obviously bottomed out from a market perspective back in March of 2000. We've recovered amazingly quickly since then, especially in those more technology-driven type of companies, Zoom being one of them, which is a platform we're utilizing tonight to do this meeting, right? And we've seen a lot of the other parts of the economy and markets come back in 2021 with the quote-unquote reopening trade, right? So all of that stuff is really good. It's got some good momentum for sure, and we think that carries us into 2022. We're also realistic. As I mentioned, we've had a fantastic run here for the last 18 months. So our views on how much money that we can make in stocks in that near-term period, remember, again, the next 12 to 18 months, we frankly think is we're still going to be positive and we're still going to make money for folks, but it's not going to be 15, 30% like it was for the last couple of years, right? So there's nothing wrong, in our opinion, with a year like next year coming in somewhere around mid to high single digits from a total return on the stock market. And that's kind of our base case at this point. Now, again, there's absolute risks out there for sure. You just have to open the newspaper or open the computer ththese days or turn on TV and you hear about the things that are going on in China and how that could potentially spill over into GDP growth for the globe. Could that be slowing? Possible. We don't think we're quite there yet. The other big thing that I do think a lot of people are now paying a bit more attention to than they have over the last 10 years, and I know we are, is inflation. Right? All you need to do is just go to the gas pump and realize that it costs, yet again, I think I just did it the other day, it was $50 to fill my tank, right? When did that happen, right? I thought oil prices were negative a year ago. So it's kind of interesting to see how that is playing out. Now, a lot of that, and you've heard this rhetoric from the Federal Reserve, a lot of it is that what we call transitory pressures. That's how we refer to it as, meaning there's issues with some supply chains. There's issues with the labor market, right? There's not a lot of people working out there. If you talk to any business owner, or if you're a business owner yourself, you know that. And folks seem to be changing careers, retiring early. COVID was a wake-up call for a lot of people from, how they want to enjoy their lives, right? So there's some of that. We think all of those things are quite frankly transitory, where they repair themselves over time. Does it happen in the next month or two? Probably not. Does it happen within the next two years or so? Yeah, we think that's probably right. Probably somewhere between 18, 24 months, somewhere in there. All of these things kind of work themselves out over the system, but it doesn't happen overnight. So we're going to have to deal with it for the next couple of years. So there is that risk for sure. The other thing I would add on to that we're paying very close attention to is interest rates, right? So interest rates continue to be historically low. We had a pretty amazing rally in interest rates in the beginning of the year, and they've come back down, and now they're starting to tick back up. So it's been a little bit of a wild ride from an interest rate perspective. I will tell you, we are listening and constantly talking to people at the Fed, getting their view on things. And what we're hearing so far is that we are still probably somewhere in the neighborhood of 9 to 12 months away from the Federal Reserve actually increasing the Fed funds rate. Right. So in our opinion, what does that mean? It means that interest rates stay relatively range bound, kind of where they are today for that, call it next 9 to 12 month period. They'll start to slowly tick up as the Fed actually does, in fact, raise rates and get back to some semblance of normalcy from an interest rate policy. But we still think we've got some time until that happens. So all of that said, what should you be thinking about? What should you be doing? Well, in our opinion, you should. And I think 2020, if it taught us anything besides how to use Zoom, it should teach you that you cannot time this market, right? You saw a precipitous drop in February and March. Over a 30-day period, we dropped over 30% in the stock market. And then you saw just as quickly a recovery over the next 60 days, right? So pretty amazing stuff. So at the end of the day, our advice is to make sure you're working with John and your team of financial advisors and make sure that you find yourself in a place that you're comfortable, right? You're not overly weighted in one area or the other, right? In an environment where inflationary pressures are a little bit higher than they have been in the past and probably will be for some time, I will tell you that dividend paying stocks usually do a pretty good job during that environment of providing some value and a nice hedge against inflation. So not just tech anymore, not just healthcare, which is what's worked over the last 10 years. We probably should have some balance inside there with some dividend payers as well. On the bond side of things, it can't just be, good old fashioned bonds. We got to think about things from a little bit different perspective. Use some portfolio managers that we have at our firm, for example, that can play the interest rate market. They can position you differently relative to the market, so you're not just sitting there when interest rates go up and taking a beating. So that's a different thing to think about too. In the last 30 years, you could have, quite frankly, just bought the good old-fashioned Barclays Ag, which is the bond index for the U.S., and called it a day. You would have been just fine, right? So a little bit of a different environment there. So our point is stay balanced, stay focused on your long-term goals. And this is where I'll end with some probably pretty good news here. our views from a longer term perspective are extremely positive, right? One thing I actually did want to share, and the only thing I will actually share tonight, because I know it's super annoying when somebody bounces back and forth between 10 presentations and whatnot. So let me pop this up for you really quickly. We put a piece together, and what it really is actually, I'll even go to the cover of it so y'all can see this real quick. If the thing actually decides to work. Is that working, John? See that on your screen? Yep, I got a thumbs up. That's all I needed. That's perfect. Thank you.
Yeah, I can see it, Dave. Yeah.
Thank you. Thank you very much. So we put a piece together called The World in 2030, right? And obviously that is 8 years from now, but that is really truly how our portfolio managers think about things. If you recall my opening comments, I said I'll give you some perspective on what we're thinking near term. I'll give you some perspective on what we're thinking kind of that intermediate term, and I'll give you some perspective on what we're thinking long term. This is where we spend the vast majority of our time, right? Where are these amazing companies in the world? Where are they coming from over the next, call it 6, 7, 8 years or so? This piece is truly a collection of those themes. Now, we're not going to give you the companies, or at least all of them, right? Because that would kind of take our job away. But we are going to give you the themes and the investment the investment philosophies and things we're excited about over this next decade. And we actually list 10 of them to keep things pretty simple. One that always makes my spine tingle that I'm going to hop to very quickly is you can see this headline: "A cure for cancer may be right around the corner." So Cheryl Frank, she's one of our portfolio managers, one of those really smart people that I referred to before. She's been with us for over 20 years. She has been nothing short of obsessed over the last 20 years of her career with biotechnology and biopharmaceutical companies. And in her opinion, she knows of a handful of companies that are out there that are really working on some amazing breakthrough cell therapy treatments that she believes within the next 10 years, what would have been a diagnosis of a death sentence today is actually completely treatable with those cell therapy treatments that they're coming out with, right? So pretty amazing to think about that it's real life. It's not a sci-fi novel. We're going to get there probably within the next 10 years. And that's the stuff that really makes us excited from a longer term perspective. Those are the opportunities that we're seeing out there. Autonomous vehicles, electric vehicles are just a few other ones that we're thinking about that you'll see inside here as well. So I want to leave you with that and remember to do hopefully what we do best, which is in fact focus on the long term. I'll kill my screen now. And that we are finding some really good opportunities out there. And again, things look pretty good from a near-term perspective. Where we are seeing some potential risks, again, puppies, unicorns, and rainbows are not forever by any stretch of the imagination. But where we are seeing some risk is kind of in that intermediate-term period, right? After we get past this growth phase that we're coming out of, this pandemic, the reopening trade, everything's done. Where do we see some growth from? That may be a bit of a struggle in that intermediate time frame, which again, is why we suggest making sure you find that balance, making sure you have that appropriate portfolio that you're going to be able to stick with things to realize the potential gains in companies that we're identifying, like the ones that Cheryl is excited about, and not capitulate when things get tough, because they will. We know it's not going to be a linear line all the way up from here till 2030 by any stretch of the imagination. We hope we're wrong. We hope it is. But if not, we got to make sure we're in a position to stick with those investments long term, to realize those long term gains, and realize all of the exciting things that we do have out there in the world today. And in order to do so, you got to be comfortable with what you're investing. So, John, I'm going to stop there. Hopefully, I prompted some questions. But as you mentioned, we're going to hold those till the end to make sure we can get through your presentation as well, because I know it's chock full of really interesting information and very applicable information. So please, if anything struck a chord, jot it down, and we'll get to it after John's comments. But John, thanks again for having me tonight. I really appreciate it.
Yeah, sure, Dave. Thank you. And I'm going to violate my own rule, as a matter of fact, and I can do that because I'm the host. But Dave, let me ask you a quick question. And I get this question all the time. I'm sure you get it all the time. In the low interest rate environment that we're in, right? So many people are looking for yield, right? Do you have any secrets? Do you have any industry secrets, John, that you can tell me where I can get 5% on my money with no risk? And you get those questions all the time, right? And it's the risk reward. It's always the risk versus reward scenario. But you mentioned it before about dividends. So I'm a big proponent of those blue chip companies that have been around forever, and they pay handsome dividends whether or not the price goes up or down. And there's a whole laundry list of them that have actually increased their dividends consistently, quarter after quarter after quarter, right? So can you just give us a couple names in the American funds lineup that would cater to that type of investor? Somebody who is willing to take a little bit more risk, of course, in the market, but it's a conservative stock market risk in the sense that it's a Fortune 500 blue chip that has been around forever and pays a really good dividend.
Yeah, I love the way that you phrase the question, John. And even before I maybe give you the exact answer, let me just frame it even more for folks. I mentioned that, you know, we've had this fantastic run in the stock market, not just in the last 18 months, but 2019 was another phenomenal year. I mean, really the last decade or so has been phenomenal. A couple bumps along the way, without a doubt, of course, but really nothing, you know, nothing of serious note since the financial crisis, right? So when you have that type of environment, right, where things have just been good for a while, well, that's an environment that, frankly, you know, growth companies do really, really well in. Low interest rates and low valuations, as we like to refer to the price of stock relative to earnings, right? That's an environment that you can basically own growth companies and kind of call it a day, and that's what we had, frankly, for the last 12 years or so. But and I may be getting a little too technical here, so stop me if I am, John. But if you think about the component of returns for stocks, it comprises three things. So price appreciation or multiple expansion, right? That's number one. Number two is earnings, right? So as the company makes more money, they pass it along via the stock. That's the whole idea of owning stocks. And the dividend, right? So if we're coming off a 12-year period, aside from COVID, right, that was quite frankly phenomenal from a total return perspective, there's going to be more emphasis, in our opinion, at least in the near term here, on those other two components, on earnings and on dividends, right? They're going to play a bigger part in the return for clients in an environment like this, where quite frankly, there's not a whole lot of cheap things that are out there in any asset class, right? So when you think about that, to your point, dividend payers in an environment like that make a whole heck of a lot of sense. Now, I'm going to give you two quick examples of companies, one that you're going to expect, one that you're not. I'll start with the one that you're not going to expect. We own Microsoft. We are actually the largest owner of Microsoft in the world on behalf of our clients, of course. Why do we like Microsoft? Well, if you think about Microsoft, they've essentially created a niche for themselves where regardless of how much they charge for their 365 suite of office supplies, regardless of how much they charge, for the cloud computing piece of their business that continues to grow, which is actually one of the lower costing cloud computing systems that's out there, people are going to pay it, right? They have the pricing power in order to basically hedge against any costs that may be attributed to inflation, whatever it may be. And oh, by the way, they have a phenomenal penetration rate in the US, but that's actually not even close to what we think full potential could be internationally, especially in the emerging markets, right? Oh, by the way, they pay a great dividend. And a dividend that they're not stressing to pay by any stretch of the imagination. You know, if they have a bad quarter, they can easily pay the dividend and they're still going to be very profitable, right? So it's not one of those massively high dividend payers where their dividend payout ratio is 70, 80% of what their earnings are, right? So that's a company that we think has staying power. It's a techier company, which is why I said you probably wouldn't have thought I used that as an example. But because of kind of what they continue to do from a software perspective, from a cloud computing perspective, that's a company we really, really like. And the dividend component, is really important for us from that perspective. The other one that you're going to see inside of our portfolios quite a bit, and this has absolutely nothing to do, well, I shouldn't say nothing to do, but we've owned it way before that they came out with the vaccine, is Pfizer. So Pfizer is one of those more traditional blue chip dividend paying type of companies. They've been around as a pharmaceutical provider for decades. They continue to provide drugs that 90% of the world consumes, which is pretty amazing to think about that from that perspective. And they're just going to continue to do that, right? So that's a company that's a more of a traditional kind of stodgier company that's well established. It's great market share. They continue to come out and with new ideas, with new drugs. They have a great long pipeline. So that's another company that pays a very solid dividend that we are big owners of and have been from a long time. And again, not just because of the vaccine.
Yeah, right. Okay. Okay, good. Thanks, Dave, for sharing that with us. Very valuable information. Excuse me. And thanks for mentioning Lisa. I also don't want to forget Mike Whitney, too. So Mike is an integral part of our team on the financial planning and investment front. Mike, it sounds like from what Dave was just talking about with all the biotech going on, we're going to have to start stretching those life expectancies way past 95 for our financial plans, right?
Yeah, we might have to look at going up to 110 soon.
Yeah, there you go. So that's good. You know, honestly, I don't mind living to 110 as long as the quality of life is there. And obviously for everybody, it probably feels the same way as well. So, okay, good. Thanks, Dave, for that. Again, valuable presentation. We'll get to other folks' questions towards the end of what I have to prepare tonight for you. And let me go ahead and bring that on right now. All right. So what I'm going to do is I'm going to shift gears here a little bit. And I'm going to go somewhere that you don't usually see financial advisors going, but it's really that important. And as you probably know, October is Cybersecurity Month. And so we're jumping right in here and want to get this information out to clients and guests because, again, it is that important. So the presentation tonight will go about 20 minutes discussing this and then take some Q&A afterwards. It's entitled 30 Minutes to Savvy Cybersecurity, 5 Threats Every Person and Business Faces and How to Fight Them Now. Okay. So again, October, Cybersecurity Month. And one of my daughters recently mentioned to me after I said I was presenting this tonight, she said just that. She said, Dad, I don't usually hear financial advisors talking about cybersecurity. And she's absolutely right. And the way I view it, really honestly, is to consider it falls under the category of really safeguarding your assets, right? And protecting one's worth. So that's the way I view it. Let's jump right in. So that the headlines are all around us. You can't turn around nowadays without seeing a headline such as Colonial Pipeline, right? Paying $5 million following ransomware attack. Or another headline, hackers steal $650,000 from nonprofit and get away with it. Another headline showing limits to law enforcement's reach. Apple's cyberflaw allows silent iPhone hack. And so again, this evening I'm going to talk and give the shortened version of what is on the podcast right now. So again, if you want to access that podcast, go to our website, www.jgigliello.com, or again, wherever you get your podcasts. And if you don't feel confident because you're not familiar with podcasts, just give us a call. We'll get you started. All right. So with any solid financial plan, you really want to first to evaluate where you stand right now, right today. Where are you today? And identify what you're doing right, where you might find areas for improvement. Well, having a solid cybersecurity plan is really no different. With that in mind, we have sent all of you again tonight attending that we have the emails for a PDF version of our Savvy Cybersecurity Reference Guide. So it's chock full of a lot of really good information. But for now, I just want you to focus on one part of it. So if you have it in front of you, that's great. If you don't worry about it. But at some point, I want you to to fill it out, especially the section A that we're going to talk about here for a second. Okay. It should take you all of about 2 to 3 minutes to fill out that 10-question yes or no scorecard part of it. And what you're going to do is you're going to give yourself 5 points for each question you answered yes. Then add up your points and determine your rating by looking at part B of this reference guide. So don't be discouraged if you scored low. Honestly, most people do. Again, knowing where you stand in the first place is really creating your cybersecurity strategy. That's what it's all about. And to be completely honest with you, in full disclosure, I scored very average on this myself, so I definitely have some work to do on my end. Now, if you have that card in front of you, we won't be able to go over all of the topics on the guide tonight, but again, feel free to ask any questions at the end of the presentation about anything we may not have covered on that card. Okay. Well, a lot of the experts feel strongly that we as consumers can be much more proactive about preventing cyber theft instead of reacting when something happens. In the next 24 hours, listen to this statistic. I couldn't believe this. In the next 24 hours, scammers will target the public with 94 billion emails, 94 billion emails. So that's 34 trillion malicious emails a year. Amazing. Over the same 24-hour period, hackers will blackmail 88,000 computer owners and demand ransom to unlock their encrypted PCs. So that's 32 million in 12 months, which averages more than 1 victim per second. Now, I believe you can develop 3 cybersecurity mindsets to strengthen and maintain your cybersecurity so that staying safe is simple. The 3 mindsets cover various parts of your life and overlap to form a sweet spot, if you will, of actions that will boost your cybersecurity score. Each mindset alone obviously provides great security, but the combination of these 3 really makes you secure. So the mindsets are secrecy, omniscience, and mindfulness. Each mindset contains a group of actions for people to take called the new cybersecurity rules. Now, I'm going to explain all 3 mindsets and some of the associated rules. Let's take a look at that first mindset. We all need more secrecy in our lives. I think we can all agree to that. And that's why our first key idea is adopting a new level of secrecy can boost your security and cyber confidence. The secrecy mindset entails keeping your personal and private data just that, private. With all the massive amounts of data breaches suffered by corporations, governments, we really need to act as if our personal data already exists in the hands of cyber criminals, because it likely does. We all need to draw a tighter ring of security around our personal data. And that starts with your email. Our email address is the key to our digital lives. We share it with countless businesses, organizations, and various people. If you've used the internet for any amount of time, you have entered your email address at a host of online accounts for shopping, traveling, exercising, gaming, dating, and more. And we really don't think twice about it. But having your email addresses in so many databases puts you at a significant risk. Hackers are routinely breaching the security networks of many of the organizations that hold your primary email address. That stolen personal data, paired with poor email security, can really lead to disaster. So Robert Siciliano, he's the CEO of IdentityTheftSecurity.com, and a noted security writer, explains, it has been said that if you own a person's email, you own the person. This means that once your email is hacked, pretty much your entire digital life is up for grabs. So even if you've done your due diligence to have all your passwords be different, if your email is hacked and it's associated with other online accounts, the hacker could simply use a reset password and get access to all other accounts. Now, you may not care if someone hacks into your Food Network or Yelp account, but you certainly don't want your online banking exposed in the same way. This is why you need to create a separate secret email for your financial accounts. This email address should be unidentifiable. Don't use your first name, last name, initials, or other identifying information. It should also be protected with a strong and unique password. A separate email address reduces your digital footprint, and if your primary non-financial email address is exposed in a hack, it will not be connected to your financial accounts. This is a key step in boosting your security. We also need to put a special layer of security on our all-important accounts, such as email, online banking, social media, and more. That extra layer is a relatively new trend in online security called two-step verification, or sometimes two-factor authentication. It should be added to any account you have that supports the technology. With this approach, when you start to log into an account online, you're sent a short-lived one-time passcode. You must use that code to finish logging in. You can receive this code via text message or something called an authenticator app. The authenticator app is the most secure option, as it is more difficult for hackers to compromise. Some popular authenticator apps are Google Authenticator and Microsoft Authenticator. This method stops your accounts from getting hacked because it requires two separate things: something you know, your password, and something you have, the temporary code. So even if a hacker has your password, he won't gain access. And you'll be alerted if someone is trying to break into your account. If you get a code and you haven't tried to log in, well, then you know something is up. And at that point, you'll want to go ahead and change your password. Don't worry, you don't have to worry about entering a code every time you log into your account from your device. On many sites, you can designate a safe device where you only need to enter the verification code every 30 days or so when logging on from that device. We also need to know what is going on with our cybersecurity at all times, right? That's why the second key idea is completing certain actions can help you achieve financial cyber omniscience and prevent fraud. Excuse me. This is absolutely critical to everyone's cybersecurity. So let's see what I mean here. Now, here's something most people don't quite understand about their credit files. By default, our credit files are actually open. That means anyone with enough information to impersonate you may be able to open a new line of credit in your name. It happens all the time and is a major source of identity theft. And when you consider how many private and public organizations have been hacked, I mean, institutions we've trusted with our social security numbers, employment history, and other details about our financial lives, you need to be worried about the state of your credit file at the big three agencies, which I'll mention in a second. We need to take back control of our credit through what's called a credit freeze. Now, a credit freeze locks your credit file with a PIN, right? Personal identification number, at each of the credit bureaus. No new credit can be issued in your name unless you lift that freeze with your special PIN. Now, you'll have to contact each of the credit bureaus separately. As of September of 2018, credit freezes are actually free in every state, thanks to new federal legislation at that time. Previously, the cost varied per state and could be up to $10 per action. Now, a credit freeze puts you in control. You're being proactive here. It's way more secure than credit monitoring or fraud alert, both of which will alert you after credit has been issued in your name. With a credit freeze, you can prevent identity theft from happening instead of cleaning up after your identity theft nightmare. But interestingly enough, it's not just your credit that you need to be concerned about. Believe it or not, experts say that 500,000 children suffer from identity theft every year. Why? Well, their clean records are attractive to thieves looking to open new accounts without any issues, and the theft can really go unnoticed for years, as parents and guardians often don't think to check their children's records. But childhood identity theft can lead to a lifetime of fraud and ruined credit. Now, for most of you on the call tonight, we're probably talking about grandkids here, but the first step in protecting minors is ensuring that they have no credit report by contacting all three of the credit bureaus. And the three big ones are Equifax, Experian, and TransUnion. Equifax, Experian, and TransUnion. Now, parents or grandparents should send a letter including copies of their child's birth certificate, listing them, if you are the parent, listing them as the parent, also a copy of the driver's license and proof of address to all three credit reporting agencies, and ask for a manual search of their child's social security number. If no report is found, you're in luck. You should still periodically check on the child's status, however. If a report is found, it's usually a sign the child has been victimized. Ask the credit bureaus to immediately place a credit freeze on the child's record and investigate further. You can now request a credit freeze for the child in every state. Previously, it was dependent on your state of residence, but again, due to the federal law changes, that's no longer the case. But again, you'll have to contact all three of the bureaus individually. Our third cybersecurity key idea has to do with mindfulness. I'm sure all of us, or most of us, have heard that term. Achieving a sense of mindfulness when it comes to cybersecurity allows you to stay alert without becoming fatigued. So what does that actually mean? We need to be in a state of relaxed alertness when dealing with cybersecurity. Fighter pilots have an acronym for this state called OODA, O-O-D-A, and it stands for observation, orientation, decision, and action. Zen masters use the phrase mindfulness. When Google completed their own analysis of worldwide cybersecurity practices, they also recommended mindfulness as a key part of cybersecurity. Mindfulness simply relates to your day-to-day cybersecurity practices. One of the biggest threats today is a strain of malware called ransomware that kidnaps your computer and holds it for ransom. In this attack, hackers infect your device with malware that encrypts or locks everything on your computer, and you can no longer access any of your files. In order to get your files back, you have to pay the hackers a Bitcoin ransom, typically. Now, ransomware attacks are normally spread through a method called phishing, right? That's the P-H-I-S-H-I-N-G version. Phishing messages are emails that impersonate a legitimate company or person and are designed to steal your personal information or install malware on your machine through a malicious link. We've probably all experienced some type of phishing at one point or another. Now, hackers are sending out billions of these messages every day. Fortunately, most get caught in your spam filter, but some find their way to your inbox. There's a 10-second cybersecurity rule that will help you fend off the phishers. The acronym is EMAIL, E-M-A-I-L, and it stands for Examine Message and Inspect Links. Let's take a look at the first half of that acronym. The first half of the acronym, Examine Message, starts with the subject line. Phishers try to get us to react quickly to an urgent situation, right? We've all seen that. Often they make the subject line something frightening, such as warning or account closed or security alert, something along those lines. Some are more subtle, but still require you to take action. For example, mail delivery failed, or return messages to sender, or incoming fax received, something along those lines. Subject lines like this should alert us that this may be a phishing attack. Next, we need to discover the true sender of the email. Phishers can spoof the from line to appear to be from a legitimate business or organization. You can determine the true sender by hovering your mouse over the display name. A small box should appear with the true email address. Other suspicious things to look for include greetings that refer to you as customer or sir or madam instead of your name. Also, poor grammar, right? We've seen that, or vague signature line with false contact information. You should also be suspicious of unsolicited emails with attachments. Never, ever, ever click to open an unsolicited attachment. What presents itself as a resume, receipt, or payment could be an executable file, an exe file, that plants a virus on your computer or seizes it for ransom. The second half of email requires you to inspect links within the message. Like you did with the sender, hover your mouse over any link or hyperlinked text. Be sure that the link is truly directing you to the correct website. If it looks fishy, delete it. You can always contact the organization directly to ask if they sent you the email. This is an action that needs to become part of your daily cybersecurity practice. So make it a habit so you can frustrate phishers without thinking about it. Boy, that's a mouthful. Lastly, part 3, it's time to take action. So we've learned a lot here in the last 20 minutes or so, and now it's time for you to take action. Research shows over and over again that we are more likely to do something if we write it down. Okay, so if you have that reference card and you printed it out and you have it in front of you, go ahead and turn it to the back side. Take a minute and look at the checklist and write down, if you can, 3 actions that you plan on taking immediately. It helps if you can sign and date your action plan commitment as well. So while you're taking a look at that, I'm just going to check in with Lisa. Lisa, you still out there? Everything going okay in cyberspace?
Yes, I'm out here.
Okay. Okay, good. Good. So again, if you haven't received the reference card, we'd be happy to get that to you. It's such a valuable resource, and that quiz would only take about 2 to 3 minutes to complete to really get an assessment of where you currently stand with your cybersecurity plan. While you're finishing up with that, I also want to point out another valuable resource. It's a new book that complements this presentation and will educate you on the items that we did not have a chance to talk about today. It's called Hack Proof Your Life Now, the New Cybersecurity Rules, and it's available on Amazon. I think it's for like $15 or so. I also send out occasional newsletters to my clients and other folks that are on my email list. It includes articles and tips about cybersecurity. There's always a stream of information coming out on new cybersecurity techniques. So cybersecurity is a topic in addition to news and articles about financial planning and investing. So again, if you're not on that list, we'd be glad to add you and get this information out to you. So now you have the core knowledge to create your own personal cybersecurity plan, or at least the ideas to get started on the plan. I'm sure you found the presentation helpful and informative in terms of your thinking and commitment to cybersecurity. It really is that important. It's totally within your power to be proactive and safer and more alert on the internet. So again, thanks everybody for listening to my presentation as well as Dave's presentation. And I want to get back on the screen and start our Q&A session here, our question and answer session. So once again, if you have a question, uh, hover your cursor down below and you'll see a button that says reactions. It has a little smiley face on it. And once you hit that reactions button, there should be another button that says raise your hand. Once you do that, Lisa will see you, and you can come on and ask your question in the live format. And if that's not working for
We
you,
have a
again, you
question.
can always send out an email to LaPlante at Albany Financial and make sure that we get it. Okay, Lisa,
We have a
anybody
question
out
coming
there?
in from Eldon.
Yeah.
Yes.
Okay. Hi, Eldon.
Hi, good. I want to thank Dave and you for the presentation. By the way, I have that book.
Excellent. Excellent.
Uh,
Have
I
you had a chance
really-
to go through any of it yet?
Yes, and I haven't done anything yet though, and that's, knowledge without application is useless, as they say. So
Okay.
it's time to take action. But I
Good for
do
you.
have a question for Dave, and it has to do with the intermediate to long-term outlook. It's sort of like two parts, but one, I noticed on that chart you put up for pharmaceutical research, that it's increasing over the years at a small incremental rate, but it's shocking how much China has put into it. They're going to be up to 50% within 2 years, which tells me that we need to be doing more. The other thing you mentioned was EVs. You can't really not talk about China, because China controls all the rare earth metals that they're going to need for electric vehicles. As far as green energy is concerned, they've got all the silicon where they're making all the solar panels. How are we going to get to where we need with the Paris Accord, based on what's going to be required for clean energy and electric vehicles, with China dominating the market so much? How are we going to get?
Dave, any thoughts?
He's muted.
Oh, you're muted. I think you're
I was the old double mute there. I think hopefully you can hear me now.
okay. Good. Yeah.
Excellent. Thanks for the question, Eldon. And it is something, the topic of China in general, I would tell you, is something that we talk about quite a lot, and in particular within the last number of months with the news that's coming out of China for sure. So first off, on the healthcare side of things, you're absolutely right. China is actually increasing dramatically the spending, not only from a private perspective, but also a public perspective, on how much they are investing in healthcare in general, not just research and development on pharmaceuticals. And that is attributable to the fact that they now have an aging population. For so many years, the Communist Party of China would only allow couples to have one child, and then it was 2 children, and then all of a sudden they realized, wait a second, we have a demographic issue. So now they want you to have as many kids as you possibly can, which happens to create an aging population, which, as we all know, means more dependency on healthcare, right? So interestingly enough, that's actually one of the bright spots in China right now, at least from our analyst perspective, is the healthcare side of things. That's where some of our largest allocations in China are, relative to years past where we like the techier companies and things of that nature, right? So that's number one. You're absolutely right about that. Number two, on the energy front and the clean energy front in particular. So one of the things that, as a matter of fact, we talk again a lot about from a green energy perspective, if you look over the last 10 years, really the U.S. stock market has dominated the world for all intents and purposes, right? We've done significantly better than almost every other country, index, whatever you want to take a look at. One area, though, that we are absolutely trailing behind is on the green energy front. And the leader in the green energy front, believe it or not, is Europe. Europe happens to be, and when I say Europe, I'm of course speaking of the major Western European countries, right? Their largest trading partner is China. So, Eldon, you're spot on. A lot of the raw materials that is needed in order to create, the batteries that we need in order to store the solar energy, one of the biggest issues and reasons why we have a shortage in semiconductors right now is because of raw materials not being shipped out of China. So it's actually a issue that frankly the world economy is grappling with as we speak, right? This is pushing a lot of different companies to think about, okay, how can we find these materials in other places? Where can we go to get them? How can we create easier ways from a shipping perspective so we don't have these backlogs at ports where there's not enough people to, get into the ships and get all the materials out, right? So, so twofold answer to that long-winded, your short question, my long answer. Number one, Europe thankfully is actually, to some extent, still dealing very much well with China relative to the trade relations that they have with the U.S. So that's number one. So we can kind of get it that way. And then number two, as I mentioned, a lot of the companies that are focused on green energy and growth in that side of the world are really thinking about how we can get it from other places besides China. So it is an absolute recognized risk.
Thanks, Eldon, for your question. Lisa, anybody else out there?
There are no other hands raised right now.
No other hands raised. Wow, we hit all the points, huh?
Oh, wait a minute. We have a question coming in. Unmute
Right.
you. This from Lucia?
Hey, yes, this is actually Chip. I'm here with Lucia.
Hi, Chip. Hi, Lucia.
I wanted you to tell me a little more about this podcast.
I would be happy to, Chip, and thanks for asking. Our monthly podcast is entitled Invest in Knowledge and debuted in early October. It's a podcast about all things financial, and our upcoming episode in early November will be about the things we all can do to shape up our finances for a great year end. Every month, I'll select a different topic to discuss related around our personal finances. Again, if folks are not familiar with podcasts, they are a fun and fast way to learn more on just about any topic that interests you. If you need help accessing them, just give us a call here at the office and we can help. Well, that wraps it up for us here this evening. On behalf of Dave Kibe, Lisa LaPlante, and Mike Whitney, I want to thank all of you in attendance and stay tuned for our next client event coming soon. Good night.